Welcome to This Explainer. Today we are looking at a blueprint that could fundamentally change how we think about our financial futures. If you have absolutely zero investment experience, well, you're in the exact right place, because we're going to figure this out from the ground up together. This is all about taking control, especially if you're young and have the most valuable asset of all on your side, time. So let's get right into it.
Here is our 5-step roadmap. First, we'll look at why saving alone just won't cut it. Then, we'll decode stocks, bonds, and crypto. Next up is the magic of compounding. After that, we'll cover how to invest with very little capital. And finally, the massive mistakes we absolutely must avoid.
Section 1. Stop saving, start investing. The invisible threat to your money.
Okay, let's dive into this. A lot of us were taught that keeping all our cash tucked away in a standard savings account is the ultimate responsible move, right? But keeping it completely idle actually exposes it to a hidden danger. Think of saving your money like parking your car in a garage. Sure, it's completely safe from the elements, but it's not going anywhere. It's totally static. Investing, on the other hand, is like actually putting that car in drive and steering it toward your destination. It's actively moving, working, and growing for you. To build real wealth, we literally have to transition from just parking our money to actively driving it forward. And here is the exact reason why. 6%. Now that number represents a typical rate of inflation, which quietly increases the prices of literally everything around us year after year. Now imagine your standard savings account is growing at, say, maybe 3%. If prices are rising at 6%, but your money is only growing at 3%, you are actually losing purchasing power over time. It's wild. Inflation is like a silent thief, and when you invest, your ultimate goal is to put that thief in the rearview mirror and genuinely grow your wealth.
Section 2. Stocks, bonds, and crypto. Decoding the investment menu.
So what does it actually mean to invest? Simply put, it means allocating your money into assets that appreciate in value over time. Instead of spending everything, you're essentially buying a piece of the future. And this brilliantly illustrates some of the basic menu options for new investors. First up, we've got stocks. When you buy a stock, you are buying a tiny piece of ownership in a real company. You can even buy into hundreds of companies all at once using something called an index fund, like the S&P 500. Now, it does carry medium to high risk, but historically, it offers great returns. Next, we have bonds. This is basically just you lending your money to a government or corporation in exchange for regular interest payments. It's generally a much lower risk play. And finally, cryptocurrency. These are digital assets, like Bitcoin. They offer high potential returns, but be warned, they come with extreme high volatility.
Section 3. The magic of compounding. The ultimate wealth engine. If there is one massive takeaway you get from this whole explainer, it's that time in the market is way more important than trying to time the market. And that's all thanks to compounding. Compounding is simply when you earn returns on your initial investment, and then those returns start earning their own returns. It is the ultimate snowball effect. Picture a snowball rolling down a hill. It gets bigger, picking up more snow, which in turn picks up even more snow. It creates massive exponential growth over a long horizon.
Let's move to and see how this builds with some actual numbers to put this into perspective. Step 1, you invest just $100 a month. Nothing crazy, right? Step 2, you earn an average historical market return of 10% annually. Step 3, you just let that compound over 20 years. You aren't just getting your money back. Your money is essentially having babies, and then those babies are having their own babies. That small, consistent monthly habit transforms into a massive nest egg purely because you let time and exponential growth do the heavy lifting for you. The ultimate goal here really boils down to one simple, beautiful idea. Imagine earning money while you sleep. That, my friends, is the power of passive income. By building a solid portfolio over time, whether that's through dividend-paying stocks, bonds, or real estate investment trusts, you eventually reach a point where your money is actually working harder than you do. And that is the true definition of long-term financial freedom.
Section 4. Investing with little capital. Your actionable starter checklist. You know, a massive myth holding so many young people back is this belief that you need thousands of dollars just to get started. Well, thanks to modern apps, that's completely false. You can start today on a really tiny budget. Here is a quick starter checklist to get you moving right now. First up, buy fractional shares. Online brokerage platforms now let you buy a slice of a company for as little as $5. You absolutely do not need to buy a whole share if it's too expensive. Second,
Look into systematic investment plans, or SIPs. Honestly, this is just a fancy term for making small, regular investments. And third, automate your monthly contributions. Set it up so that 50 or $100 just magically leaves your checking account and goes straight into your investment account every single month, totally automatically. Consistency is way, way more important than the size of your very first investment.
Section 5, mistakes you must avoid. Setting your behavioral guardrails.
So the crucial point is that the math of investing is actually quite simple. It's our own psychology that usually trips us up. To manage risk intelligently, we have to set up guardrails to avoid some classic traps. For instance, definitely do not invest blindly without doing some basic research, and absolutely do not just follow the latest social media hype. The market is going to go up and down. That is totally normal. But making emotional decisions like panic selling out of fear during a crash or buying out of greed during a massive rally, that will destroy your portfolio. Also, stop trying to perfectly time the market. Seriously, nobody can predict the future. Investing is a marathon, it's not a sprint. We absolutely must have patience for that long-term growth.
Which brings us to our final thought. The ideal moment to start investing isn't some perfect, magical, risk-free day in the future. It's today. Your future wealth literally depends on the choices you make right now. You've got the knowledge, the analogies, the checklist, and the guardrails. Your snowball is packed and waiting right at the top of the hill. So the only question left is, how long are you going to let it sit there before you give it a push?